Hi, everybody. Welcome back to Ox Talks. Appreciate you watching the show today. As always, please like, share the videos with as many people as you possibly can, and subscribe to my channel if you haven't already subscribed. I do appreciate the support. We are growing the community and growing the channel. So let me jump right in because I don't understand what's going on with markets today. The setup is very, very odd from a layperson perspective. What I don't get is this. Leave your comments below if you have any insight on this or any perspective. We have a 10-year bond yield right now, which is down almost 8 basis points. That's a pretty sizable drop in the 10-year, okay? So you have a flight to bonds. People are buying bonds. At the same time, you have a stock market here, and it's about an hour till the market's going to close, and it's selling off a little bit, nothing major, but it's red across the board. Dow's down about 100 points. Who knows where it will finish up? But here's what's interesting to me. You also have gold basically flat. Usually when you have a 10-year down 7, 8 basis points, you have a market pretty much rallying, usually green, and you have metals doing pretty well. So I don't understand the setup here, but I wanted to start with that before I jump into today's story. And I think it's a very important story. It came out of a CNBC this morning early. I was having my coffee, and it struck me odd because I had just reviewed another story, which I'll share with you from Markets Insider, about the jobs report, which is coming out on Friday. And let me jump right in, and I want to get your input and your thoughts as well. But this is what I'm talking about with regard to the thumbnail today about the Fed panicking. Atlanta Fed President Bostic says officials cannot wait for inflation to hit 2% before cutting rates. Again, out of CNBC this morning. This is Atlanta Federal Reserve President Raphael Bostic signaled Wednesday that he is ready to start lowering interest rates, even though inflation is still running above the central bank's target. Previously, one of the more hawkish policymakers, or in favor of tighter policy to fight inflation, Bostic noted that his focus is shifting more towards the employment side of the Fed's mandate as signs increase of labor market softening. I believe he says we cannot wait until inflation has actually fallen all the way to 2% to begin removing restriction, because that would risk labor market disruptions that could inflict unnecessary pain and suffering, he wrote in a message posted on the Atlanta Fed's website. Very interesting comment. He's coming out saying that if they don't cut rates right away, there could be a risk to the labor market, disruptions to the labor market, unnecessary pain and suffering. Unnecessary meaning let market equalize itself and find fair value. We don't want that, right? We want to keep artificial monetary policy in place and keep kicking the can. That's what basically he's saying. But the timing is interesting. Before we get Friday's data, okay? The Fed's preferred measure showed inflation running at 2.5% rate in July. Yeah, sure. And just a slightly higher than 2.6 core rate when excluding food and energy, okay? He says Bostic did not specify when he thinks the Fed should start easing. However, the missive comes with the markets already widely expecting, okay, the central bank's Federal Open Market Committee to cut its benchmark borrowing rate by at least 0.25 percentage point when it meets September 17th and 18th. As an FOMC voting member this year, Bostic's views carry extra weight. Okay, so when this guy speaks, it's a big deal. Extra weight and add another level of assurance that the Fed will enact its first easing since the emergency measures it took more than 4 years ago in the early days of the crisis. His comments also come 2 days before what is expected to be a pivotal non-farms payroll report, as most economists see the labor market losing momentum. And hold that thought with my next article I'm going to share with you. Bostic said his experiences with business leaders in the Atlanta area reflect that concern, i.e. the concern that the labor market is losing momentum. And he says, rest assured, I do not sense, and here's the warning, but then don't panic, right? So if someone tells you not to panic, what do? Okay? He says, rest assured, I do not sense a looming crash or panic among business contacts. However, the data and our grassroots feedback describe an economy and labor market losing momentum, he said. The upside to this is that the slowdown in activity is feeding a continuing welcome decline in the pace of inflation. Given the circumstances before us, he says, eroding pricing power and cooling labor market, I've rebalanced my focus, he says, towards both sides of the dual mandate for the first time since early 2021. So he has completely pivoted and changed his position. When it says earlier he was one of the more hawkish individuals on the FOMC committee, he was the one coming out saying, no, we need to keep raising rates. Okay, now he has done an about face. And the timing, I think we must question that. His conclusion is, based upon his business contacts in his area, is that labor market is softening and they must act now. Okay, but he says don't panic. Next article, which ties into this, is from the Markets Insider, also came out today. And listen to this, it gives you a little different food for thought. The stock market's biggest risk, it says this week, is a hot August jobs report, according to a Bank of America. This is the biggest risk. And by the way, before I jump into this, it's interesting. I expected the markets to rally this morning once I saw those comments from Bostic. Okay, I expected the markets to rally and gold to rally. The markets got a little bit of a bump, but it wasn't major. And now evidently it's kind of cooling off. So interesting point there as well. Only when they parade out the Fed members to say, yep, we're ready to start cutting rates, the markets cheer that and they immediately go up much higher. Isn't really playing out that way today. Okay, back to this article. The biggest risk for the stock market this week is a hotter than expected August jobs report, according to Bank of America. The bank highlighted the risk in a note on Monday, arguing that a too hot employment reading would reprice the number of expected interest rate cuts this year, meaning that the Fed would not be as willing to cut rates this year or as aggressively cut rates if that jobs report comes out hot on Friday, meaning more jobs than they're expecting. So again, if you think about the timing of Bostic's comments today before that jobs report comes out Friday, it makes you question, okay, makes you wonder if there really is some panic behind the scenes. Equities seem, this B of A says, more excited about the cuts than concerned about a potential recession, gauging by their return to near highs and the outperformance of small caps and equal-weighted S&P. Bank of America strategist Oh-Sung Kwon said, yeah, of course the markets care more about the rate cuts than potential recession. They just want more easy money policy. He added, if that's true, the main risk for equities this week is a hot NFP, non-farm payrolls report, NFP, that reprices short-term rates higher, not lower. The August non-farm payrolls report is set to be released Friday morning. Economists expect 162,000 jobs to be added to the economy last month, which it says, if accurate, would lower the unemployment rate to 4.2% from 4.3%. Economists at Bank of America expect just 225 basis point interest rate cuts this year, while the market's pricing in recession-sized rate cuts of 100 basis points, according to the CME FedWatch tool. So, I mean, the market, if this is accurate, is pricing in double the amount of rate cuts, the size of the rate cuts, as this Bank of America strategist is pricing in. So someone's going to be right, someone's going to be wrong. If the markets have if they're over exuberant, watch out for a sell-off. Again, not trading advice, not financial advice or economic advice. It's just my assessment. If the U.S. economy sees a strong rebound from the weak July jobs report, it could drive a sentiment change in the market and prove that investors are overly confident in the Fed's rate cut path. If you watched my video from yesterday and from last week relative to warning in the stock market, that was the concept that the video dealt with last week, which is this is potentially over-exuberance in the market, okay? One Wall Street strategist who expects a hot jobs report on Friday is Ed Yardeni of Yardeni Research. In a note to clients on Monday, Yardeni said he expects 200,000 to 225,000 jobs were added to the economy last month. Okay, and that's in contrast to what the economists expect of 162,000 jobs. If accurate, this would blow away economists' estimates and align with the strong jobs reports seen in May and June, playing into the idea, it says, that the Fed doesn't need to cut interest rates all that much. And very unlikely that the Fed will have to lower the federal funds rate as rapidly and by as much as was necessary during previous monetary easing when financial crisis triggered credit crunches and recessions, Yardeni said. So, I mean, if he's right and the markets are on the wrong side of this thing, you're not going to see, you might not see any rate cuts out of the Fed in the September meeting. And if you do, you might see, much slower pace. So anyway, you guys can, think that through, leave your comments, let me know what you think. And again, I appreciate all of you for watching, sharing the video, subscribing to my channel, hitting the thumbs up button. Talk to you all soon. Bye.